I don't blame the Fed for it. The US Fed was probably doing its job because they had to bring down inflation. High inflation is a challenge, is I think a complete no in the US economy. So Fed was completely focused on inflation. But the financial institutions and the banks, perhaps they had not adequately factored for the change in the cycle, for the cycle to turn down. That is, perhaps there was a belief, that this low for long interest rates remaining low for long will continue to remain long and perhaps will continue to remain so till eternity. Now, that's a fundamentally wrong assumption. So, therefore, whenever interest rates are low or any situation, I think one has to always prepare one has to always keep his balance sheet so resilient that it's able to withstand the shocks which may originate when the cycle turns. So I think perhaps that is something which happened, and lot of literature is already written on this. There will be more research as to what happened in the United States banking sector. But so far as the Reserve Bank is concerned, we are fully mindful of such possibilities because we have seen them in the past. And having seen them in the past, the Reserve Bank, as the bankers who are present here, they would very well know. We have, for example, we have prescribed capital and liquidity requirements, and we have made them uniformly applicable to all scheduled commercial banks, irrespective of their asset size and exposure. I'm talking about scheduled commercial banks. We have also investment fluctuation reserves requirement, which the banks and which the banks are expected to create, and they have created. We have also introduced valuation guidelines valuation guidelines on available for sale category of investments, and which are pretty stringent. And our approach has been fairly conservative in this regard. So therefore, so far as India is concerned, we did not see the kind of financial stress or the banking stress because our regulatory requirements ensure that the banks themselves had taken the required steps, and they were ready for a change in cycle and for a regime where interest rates are tightened and interest rates are increased by the central bank. Also, what helped was that our calibrated approach in increasing the interest rates. Recently, in a speech which I delivered in Delhi, those of you who are interested may like to have a look at it at the Kautilya Economic Conclave. There, the theme of my address was the interdependence between price stability and financial stability. Now, price stability is very important for financial stability. Financial stability is also very important to ensure price stability, and there is an interplay between the two. And in that speech, I have tried to explain and tried to demonstrate using certain recent examples how sometimes excessive focus on one at the cost of the other can generate potential stress. And I have argued that what is therefore required in all situations is to take a balanced approach, and both price and financial stability, they need each other. But that balanced approach is necessary so far as policymakers are concerned, because financial stability ultimately is the backbone for any country's growth, and price stability also is something which impacts not only household consumption, not only the standard of living of the people, but it also impacts financial stability. So I'm not going further detail into that, but let me now move on. Now, on exchange rate front, I was talking about our recent policies and the recent situation that prevails. On the exchange rate front, the Indian rupee has exhibited low volatility and orderly movements relative to peers despite elevated US Treasury yields and strong US dollar.